Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to have everybody here. We are here to try to help you make your retirement better. We do that by answering your questions. Send in your questions anytime, actually, but certainly you can do it now during the show also. You can do that two ways. Send it by email through asktom@talkmoneywithtom.com, or send it to the chat. Either way, we'll try to answer those live as they come in. And then obviously, our big objective here is to try to help people with their education level. So this channel is available. You can subscribe to the channel. You can push the bell button if you want to know, when we put new content on. We've got a couple thousand videos on there now, and lots of good content, I think, also. So, and of course, if you want to, you can meet with Ethan and I on a one-on-one basis, and we'll be able to help you. We specialize in kind of retirement planning, asset management, and tax planning during retirement. So those are kind of our big areas. We have a book appointment button, on our website. Looks just like that. There's a link for the website here on the channel, and you can set up a 30-minute time to meet with Ethan and I. I'll be happy to talk with you as far as that goes. So I do like to start off every week kind of with a summary of what I saw happening in the market this week. I'm going to put a little bit of a twist on that too and kind of answer some questions that are coming in. So let me start with the chart here. Because the number one question I'm getting in our client strategy sessions, and we've had write-in questions come in, how are the Trump administration policies going to affect my accounts, in the stock market and the bond market and what have you. And this is a picture obviously going back to middle of 2018 of the S&P 500. And you can see there's a drop in 2018, then the big pandemic drop, big run up. Drop again in 2022 there, and then we've been running ever since. So we're still obviously in a primary uptrend. Last week we're up 4.7%. This week we're down maybe 2.2% at this point in time. Pretty normal. I will say one thing, just to reemphasize, because maybe the next time we have a presidential election, people will be able to see it a little bit differently. But I had a lot of people, depending on what side of the spectrum they were on, say that, okay, if they were Trump voters, they were saying if Harris gets in, the stock market's going to fall. If they were Harris voters, they said if Trump gets in, the stock market's going to fall. And then we were pretty, definitive about what we thought would happen. It was the most asked question in our, sessions for quite some time, was that the stock market goes up when the election is over. And so sometimes people see that as a blue stamp, a positive stamp on that particular win and that administration. I actually don't see it that way personally. I think more than anything, there's money that's held back due to the uncertainty of going into the election, and then it all comes in. And I think it came in at such a high rate this time, possibly because people are excited about Trump, but maybe even more so because it was an uncontested election.
I think there's also certain industries that were up and down. Yeah. iClean, which was a very heavy green energy, was down, but other industrials were up. So you can kind of see how certain sectors will get influenced by the market pouring more money into it, more money out.
And so that's exactly right. Whoever wins the election does have an impact on where that money's going, right? So maybe your green energy would have run harder if Harris would have won versus the oil and gas that we saw run here, financials and those types of things. But overall, when you look at the S&P 500, historically, because it went up after Obama was elected, it went up after Trump was elected, it went up after Biden was elected. So it goes up, and so I think there's a group of people that are happy, so that helps. But there's definitely a directional with the money, which is why I say it's held back. Mm-hmm. So I mean, if you don't know who the president is going to be, and you're sitting there September and October, and you've got money coming in. These are for the big money managers, right? So they've got money coming in. And so maybe you wait until after the election and you pour money into the banks or whatever it was that, ended up running this time. We saw banks, industrials, energy, consumer discretionary ran too, but that's really, if you look at that, was just Tesla, because that's in that category as far as that goes. But anyway, that's kind of our, the outlook. Next time we have presidential election, we'll have the same outlook. But there's always a lot of concern about what's going to happen. The other thing to keep in mind here with this market, because I do want to talk about the big question of, how does Trump administration's policies potentially impact the market? Keep in mind a couple of things that I think are super important. I'll start with these because they're so important. Number one, What's the market doing now? So the market has tremendous momentum based on good earnings. It's moving really well. Spectacular motion, actually. Matter of fact, this would be a great chance to cover. Back in November of last year, we talked about the Zweig breadth indicator, right?
Thrust indicator.
Thrust indicator. So that's kind of a mouthful, but it was originally developed by Martin Zweig. It was the 18th time it happened. It was November 6th-ish of last year. And what it is a massive movement of stocks in a very short period of time. And in the previous 17 times, the stock market had been positive 12 months later, 100% of the time. So we have some clients that are really into this indicator. And so now that we're through with our 1 year, stock market's positive. So now we're 18 out of 18 on that. And it was actually up, 35.8% from this year to, from last year to this year. So again, that's just showing what the momentum is. And you got to look at this and say, okay, this is a big ship. It's really hard to turn this ship around once it gets going. Not impossible, but that is on the good side. No matter who is going to be in office, no matter who is going to be in Congress, the stock market already had a lot of momentum, and the economy's in pretty good shape, right? So both of those things have some momentum behind them right now. And so, that's kind of the issue. Then the second main thing I want to talk about that I think is important, this is just from my experience, and actually I've read this in a couple different books too. What happens is when everybody gets on one side of the trade, so if everybody thinks the stock market's going to come down for some reason, it almost never comes down. I mean, matter of fact, if I was a betting person and everybody thought one way or the other, you can go the other way. You'd probably be more accurate. So if everybody thinks the stock market's going to take a dive because of tariffs and all these other things, it's not the known things. And it doesn't mean the market doesn't come down. It can come down 5-10% and come back. I'm talking about the big ones, because that's all that really matters. If you're worried about 5-10%, you probably shouldn't be in the stock market, honestly, because it happens so frequently. I'm more worried about the 30% and the 20+%, the true bear markets as far as that goes, which are a lot less common. And those are usually precipitated by something that is a surprise. So Lehman Brothers going out of business, we were down 20-some% at the time Lehman went, and it dropped another 30, like a cliff. I mean, really hard.
Yeah, people were shocked by the
company had been around forever, and then maybe even more shocked by the repercussions of what happened. So it was like a house of cards falling on all those credit default swaps and all those mortgage loans and what have you. So, it's usually not something we're talking about that is the real issue. So just, big portion of what we try to do on this show, what we try to do with this channel, is to point out the positive sides, because we can all easily identify the negative. And so what are the positive sides? Positive side, economy is doing well. It's hard to turn that around right away. Positive side, the stock market is doing very well. It's very hard to turn that around right away. And so you also have, I would say in my lifetime, I don't know that there's a president who has talked more about the stock market and tried to use it as a litmus test or an example of how well he's doing. I mean, Biden did really well. He was up 50%, didn't talk about it until the end, just kind of the way that they worked. Trump cares about the stock market, and so I do think, again, that's another positive. Even if he does some things that potentially would hurt the market, he might reverse course or figure out other ways to do those things. Here's a great example. So if you look at that first downturn, it's right over the Talk with Money logo there. That was the very end of 2018. Matter of fact, the bottom point was the Christmas Eve. And that period of time, Trump was implementing tariffs and really going after China in this particular case. And the market starts to fall. At the same time, the Federal Reserve was raising rates because they were seeing some inflationary pressures in 2018. So the combination of tariffs and rates brings the market down 19%, 19 point something percent. Now the Fed reversed course, and Trump actually reversed course a little bit. He stopped, doing as much as he was doing, and the market came back pretty quickly, right? So a couple months later, it's back as far as that goes. So the other thing that I'll point out is kind of a positive, people probably don't realize, but during Trump's term, he put in $300 billion a year worth of tariffs, right? They're still going today.
Yeah.
As a matter of fact, Biden's administration re-upped those tariffs, not all of them, but most of them, in May of this year, and then added some other tariffs, specifically the Chinese electric vehicles, as far as that goes. Uh, so think about that for a minute. Now, that obviously probably contributed to some of the inflation that we had altogether, because if those aren't there, maybe costs are a little bit down. But we have a situation where those tariffs are put into place, back in 2018, for example. Look where the market is.
Yeah, the market kind of absorbed it and moved on.
Yeah. So now, here's the difference. All right, let's take a look at kind of what they're talking about now. The difference is maybe just magnitude. And you don't know whether it is just a negotiating tactic or if it's really going to happen. So, for example, 10%, global,
Yep.
Tariff. So no matter where they make it, it's 10% tariff to come into the U.S. One advantage to that, and why they were talking about that, is because people can kind of get around the China one, for example, and go someplace else.
They go to Vietnam,
Yeah.
Cambodia. Basically, parts come from China, but they just cycle through.
Yeah, exactly right. So they don't have a tariff to go from China to Vietnam, so it goes to Vietnam first, and maybe final assembly, and comes to the U.S. without a tariff. So that. But that is a bigger tariff than what we're talking about when we're just talking about China, right? They're talking. One of the talking points was a 25% tariff on Mexico, right? Specifically on the car industry, right? And which is kind of really complicated because we get so many of our parts that we actually assemble here from Mexico. And then a 60% tariff on China. So again, are these the real numbers that we're going to end up with, or is this a negotiating tactic to get a better trade arrangement or whatever it is?
Is he trying to basically anchor? You anchor at this very high point.
Right.
Then when you come in at 30%, you seem a lot more reasonable in a sense.
Yeah, exactly. So in theory, just to describe what would happen with the tariffs, at least just looking at what's happened in the past. So if you have a 10% tariff, you don't end up with a 10% increase on the product itself. Because what does happen is some of that increase is absorbed by somebody along that chain of sale, and so their profit margins might go down a bit, right? There is often like I saw a statistic saying that if the 10% tariff on things that would be grocery related, you'd probably see groceries go up 1.5 to 5%. Okay, so the other part is absorbed by somebody else in the chain, so to speak. Now this money is sort of coming out of the pockets of these people, but it is coming into the pockets of the government. And one of the reasons I would assume that Biden decided to extend the tariffs that Trump had put into place is it's $300 billion a year coming into the country. And you got a deficit already. Do you want to increase that deficit more by canceling all those tariffs, or keep that cash flow coming in? And that's why tariffs, unfortunately, tend to be kind of sticky. And so, is it inflationary? Almost universally, everybody says that tariffs are inflationary.
Yeah, and a lot of companies in their earnings calls this last quarter has basically said that majority of the tariffs that they incur, they will pass along the cost to the end user.
Yeah, exactly.
And so most of these companies' profit margins won't hurt too much.
Yep.
But the end user who's paying the cost will take the brunt of it.
Right. So then let's talk about kind of the offsets, at least as they're being presented. I don't know if they work. I don't know if any of this stuff is going to happen, and I think that's a key component. Don't try to guess what's going to happen and make guesses with your investments, in my opinion. Let's wait and see what happens and kind of react to that as it happens. But so if tariffs increase, the costs, where could there be an offset? Well, there's talk about reducing taxes in several areas: taxes on tips, taxes on Social Security, and taxes on corporations. I believe the one piece was going from 21% on corporations down to 15.
15 if it's domestically manufactured, their product. So essentially, they're trying to use tax incentives to have corporations bring their manufacturing inside.
Right, and so that's somewhat of an offset. Maybe not individually. Like if I don't have Social Security or tips, maybe I don't individually gain from that. But overall, when we look at the stock market, you are looking at the overall, not your situation specifically, unless your situations happen to match the overall, which sometimes it does. It really is just the overall. And so what happens there theoretically is that it can have somewhat of an offset on those increased costs. All right. Then they're talking about, another offset would be the lowering the cost of gas, right? That was a big one. a drill baby drill thing that they talked about. I'm a little skeptical of that because I'm not positive that the CEOs of these big energy companies want to see the price of oil plummet down to $40 a barrel.
I don't think so. I think
Yeah,
they're happy. They're happy because production is at an all-time high in the
yeah,
U.S.
yeah.
It's still increasing, and
Right.
so it's like I don't think deregulation is going to really push more oil to the market.
Well, it could, but I'm not sure that that's what they would want. And they're in charge of trying to maximize profits in these companies. And so, what's their incentive to drill, baby, drill? In terms, again,
Cost of drilling has to be low enough that you can make a profit, a reasonable profit.
yeah, but it has to be low enough so that you can make a profit that's higher than what you're making now.
Yeah.
That's different. So, if you're at $70 a barrel and you're making XYZ in profits, and all of a sudden we're down at $40 a barrel because we're flooding the market with oil for some reason, the profits in total, the volume has to pick up. There has to be a lot more interest in buying that at that lower price. And obviously that is true. The guns and butter concept, when the price of gas comes down, probably the consumption does go up. People might take more
The,
driving
the only problem
vacations.
is if you oversupply, then you have major issues.
Oh yeah, and that's happened with that. It happened in that pandemic, right? We actually went negative on oil. So, but that's a potential offset, and maybe some of the pieces. I'm just trying to map out kind of what I've seen, the kind of pros and cons, and what they're trying to do. The problem with the tax cuts is that the government is already running at a really big deficit.
Yeah.
And so the bond market, although the stock market has done well, the bond market actually went down last week after the election because they're seeing some of these, things being twofold. Number one, possibly inflationary. So if it's inflationary, maybe the Fed has to raise rates, and so the bonds yields start coming up, which means the values go down. Number two is if you have a higher deficit because you've cut taxes even more, now you're flooding the bond market with even more bonds. And sometimes in order to get those to be sold, you have to increase the yield. It happens in a market mechanism. You're not setting the yields per se, but so that's there's a constraint for how much they can do in terms of tax cuts.
Yeah, because he's saying we're going to basically lock in for permanent, the individual tax cuts. We're going to increase child credits from 2,000 to 5,000, and then also remove the SALT taxes.
Yeah, that's right. Remove the SALT tax would be a big cost.
And so, being able to afford all this, something has to be slashed in the budget, or you have to raise revenue somewhere else.
So that's where the other part comes in. So okay, we get tariffs that go up, right? Increases cost possibly. We save on taxes, right? Potentially, we save on energy cost. We obviously increase the deficit, and then we deal with that by cutting costs across the board on the government. Elon Musk was talking about cutting $2 trillion. I think it's a $6 trillion budget altogether. Yeah. So cutting a third of the budget down. And so theoretically, right, if you look at that, that's the offset to that higher, need. So in other words, if I cut my tax revenue base down, and I can equally somehow cut down my expenses, I could be at least at the same spot. The bond market might relax in that spot where we are now, even though now is still a little high, in my opinion. Those are all the portions that are supposed to fit together. And so if those all worked, you would definitely have volatility for some period of time, even for maybe a couple of years. But if they actually worked, maybe you end up with a decent scenario as far as that goes. I think the real problem is, man, you are talking about a whole bunch of pieces that are super complex having to come together. It's like I read an article about how hard it is to really restructure government organizations. And the process that has to be gone through is law. It's not like they can just come in. I mean, as an entrepreneur, you might think, oh, I can come in and do these things, but you can.
Yeah.
And many people that are in business have come into government and figured out that it's not a business in that regards. And so, so then if you're cutting taxes, which they might do pretty quickly, or extend the tax credit, the 2017 taxes, to longer, if you're cutting, corporate tax and all these things, can you actually make the spending cuts work?
Yeah, essentially the goal with tax cut is if you able to do these tax cuts, will people spend more money or generate more revenue too? Is another
Yeah.
thought. Can you offset it? Because the washing machine tariff, which was pretty in 2018, was pretty aggressive.
Yep.
But it forced Samsung and LG to build manufacturing plants that they've maintained in the U.S.
Yeah.
And so that's kind of the goal with these is to force companies into the U.S. But there's a lag period with building factories and how much jobs they'll actually create. It's kind of an expensive way to create jobs.
Yeah, and it sort of throws out the whole. It's not really dealing with the whole concept of the retaliatory tariffs, because now, okay, great, we're making more stuff here in the U.S. That means we have to export it, at least in some cases, to countries that are now putting tariffs on our goods as a retaliatory aspect of that. And you're talking about like global inflation in a scenario like that. And so that's we'll see how that plays out. Again, I don't think we can, assume we know what's going to happen. And we just have to kind of go along and be reactionary. Okay, so there's one other piece of this platform, should we call it, which is, deporting every illegal alien out there that's here, illegal citizen as far as that goes. I read an article saying that 73% of illegal aliens work in the agriculture industry. And so how does that work? So how do you get rid of this massive labor force that is producing goods that are going to the grocery store, where voters seem to be the most sensitive?
Yeah. And the whole idea is this is by deporting illegal immigrants, you free up jobs for American workers and you free up housing. And so that was kind of like the base idea.
But I don't see it. I don't see Americans. I picked apricots in the summers when I was a kid. I don't see a bunch of teenagers out there picking the strawberries and doing the different things that need to happen. We already have over 8 million open jobs right now that people won't take. They're who's going to really take those jobs? That's been kind of proven over and over. So I see a couple of issues there. Number one, if they actually do it, that's going to be a problem. I don't know what the offset is for that. We picked off, okay, we can find an offset for tariffs, maybe. We can find some offsets. But when you look at the illegal immigrants moving out of the country, if they can do it, and that's a big if, but I don't know what the offset is. How do you get
I would
the
assume
food to the table?
I assume they'd try to do more of the temporary access. So
Project 2025 was trying to get rid of that.
They're trying to get rid of the temporary
access. I think the other part of this that's being ignored is the farm industry is pretty strong, and so I think they're going to have something to say about this. So it's going to be really interesting to see how that part plays out and how that does. So here's the problem: if they do something that becomes inflationary and don't have an offset that doesn't come around fast enough, then you have the Federal Reserve raising rates, which, they raised rates in 2022 to fight inflation, and we ended up with a 28% downturn in the stock market, especially when you're raising rates fast, like they did then. They raised rates in 2018 where tariffs were being done, and we ended up with a 19% drop. And so that's where I think that one piece for me, I haven't been able to make that work. Again, I'm keeping an open mind to the fact that it might not actually happen. That type of thing has been talked about before and hasn't happened. There are forces, big money that's behind some of these things that might come in and say, no, you really can't do that. You can do this, but not that. So we'll see what really happens. Is it just campaign rhetoric, that's coming through that gets you through the door? And then you can kind of go on your way and do something else or not. But actually, I find that part the most troublesome in terms of trying to figure out how that's going to be an offset. I don't really see the job growth coming for Americans from exporting, the agriculture industry jobs. I don't even see the housing, being massively indicated. Maybe we'll see. So anyway, that I get the ideas. I see what they're doing, the framework of what they're talking about. It actually has potential, but it's really hard, and it has probably even more potential to fall apart in different places because it is so difficult. You're basically trying to thread a needle in this case especially to get all these things to match up in real time. Because one thing, okay, we cut taxes, all of a sudden the bond market's freaking out over here, and we don't have our spending cuts done yet because that's going to take a couple years. Well, what happens during that period of time? So I think, if you have offsets, they need to be coming in at the same time. And I think that's going to be really hard to do. Tariffs are fast because that can be done on executive order for the most part. And so I wouldn't be surprised we don't see tariffs at day one as far as that goes. The tax cuts can be pretty fast.
Yeah, essentially, I would say in the first 100 days, likely tax cuts would get pushed through.
Yeah, if you have a Republican-controlled Congress, and you're talking about some of the tax cuts are going to be popular, from a voting standpoint, people aren't going to complain about them too much, although, the deficit can balloon up. And that's where that bond market creates problems, because the bond market starts to freak out about those tax cuts and the yield goes up enough. See, when you could get 5-7% on a treasury, and the stock market makes 11% on average, and you can get a treasury that gives you 5 to 7 with basically no risk, it takes money away from the stock market. That's where I think it's going to be really challenging, is to see how this is all juggled out. And honestly, even the best of the best would probably have a really hard time doing this right, because it is so complicated. But here's how you deal with it. Keep an open mind. Try to find some of the positive to go with the negative. That's true for every single situation. This show started at the very bottom of the pandemic in terms of that chart right there, because I was trying to show what was positive about the stock market and the economy, just to make a balanced opinion of what's going on. So have an understanding of what could be positive to go with what we all see as negative. And then secondly, don't be proactive. You don't know what's going to happen. Nobody knows what's going to happen for sure, and how the market's going to react, or what they're even going to do or be able to do. And so be ready. And that's how we do it. So we have our universe of ETFs, and we watch those, and we look for those things that are moving up. We've moved into T-bills on the bond portion of our accounts, because the bond, that's moved up to the top. Right, the bond market itself has gotten soft enough that the T-bills, which are short term, don't move that much, and and actually paying decently now, which is nice. But it's basically, that's the reaction. So you make those reactions as you see the different things transpire. Don't guess, and don't move your money someplace or try to go someplace, at least in whole. Like we bought some financials, and we've bought some industrials in our targets and such too, because that was moving upwards as far as that goes. Again, we didn't do that in advance, guessing who was going to win the election, those type of things. We do it as a reaction. I talk about that all the time, projection versus reaction. Almost everything you hear about in the news about the stock market is about projection, because it sells. It's cool. I like hearing it too. I love hearing it. CNBC, some guys can tell me what's going to happen. I'm fascinated by it. But honestly, as an investor, if I'm constantly out there running my money out in front of those projections, I'm going to be wrong, in my opinion. And that's true for everything I've seen. For every time you're right, you might be wrong 2 or 3 times, enough to the point where you're not making any money with that.
To be a profitable investor, you have to win more than you lose, in a sense, or let your winners run out.
Yeah. And the average individual investor, has a horrid rate of return, less than inflation. Horrid. And there's 2 reasons for that. They buy things that have a great 5-year track record. Well, that's probably all over. And number 2 is that they tend to use projections more. Oh yeah, this area is going to be great, so I'm going to buy it. I want to wait until it starts to become great, capture that momentum, and ride it as long as it's going to go. That works. That's worked for us. Anyway, with that in mind, that's kind of how you want to handle this scenario that we're dealing with here for this change in administration. It's confusing, it's complex, it's scary, but there are some potential positives that could happen. Let's see how it plays out, and let's see how we can deal with that in the portfolios. We're ready. Our system is uniquely designed for things like this, in my opinion. So we'll be ready for whatever happens, but don't discount the fact that things could go up a lot. Trump's term was 67% on the stock market in the last first 4 years that he had. He does care about the stock market more than most presidents, I think. Matter of fact, Jeremy Siegel, who's a professor at Wharton School of Business, came out and said that Trump is the most stock-minded president maybe ever. I don't know if that's true or not. He knows more than I do, to be honest. But that's a positive. That's something to keep in the back of mind. I think the biggest problems will be more the social issues and the dealing with all the different antics that happen and such, and the political side. That's not going to go great, in my opinion. But the stock market and the economy could do okay here, right? So we'll see. We'll be here talking about it, kind of analyzing it, and what have you, as far as that goes. But don't be too nervous. Things could work out better than you think. We'll see how it goes. All right, so that's our summary for the week. A little bit different, just in the sense that we, really talked more about policy, just because we've been overwhelmed with questions this week, both in our strategy sessions and emails that we've gotten, and people are concerned about this particular question, rightfully so. We'll try to develop some more, content around that so you can see what we're talking about. I think it is important to see the pros and cons of what has happened in the past, at least, and kind of understand, what that means. So, anyway, thank you very much for joining us on this, summary, and we'll look forward to doing this again next week. All right, what's our first question?
Who can I write QC or qualified charitable distribution checks to?
Okay, so qualified charitable distribution checks, QCDs. So these are important. These actually became more important after the 2017 tax cuts, because they raised the standard deduction to the point where a lot of people couldn't itemize.
Yep.
Matter of fact, I think most people don't itemize.
Yeah, that's one positive of this tax cut, was that less people itemize, keeps it simpler.
But then that meant that if you were, giving to charity and you weren't itemizing, you weren't getting to write that charitable deduction off. And so they wanted to try to help charities. So they created this qualified charitable distribution, which is if you are old enough to be required to take money out of your retirement.
So they didn't
plans.
actually update the age. So it's still 70 and a half, actually.
Yeah. Oh, that's right. That's right. So if you're over 70 and a half, you can write out checks or have checks sent from your IRA directly. That's important. Don't put it in your bank account and then pay the charity. The money has to go directly to the charity, one way or another. Either you get a checkbook. That's what we try to do with the clients. Get a checkbook that you give, write the check out to the charity. Make sure they cash it in the year that you're writing it, because that's how you get the write-off. So if I am over 73 in this case, and I have to take money out, let's say it's $10,000 that I'm required for my minimum distribution, I can write out $10,000 worth of checks, or have $10,000 worth of checks sent from the custodian.
And it has to go to basically a 501.
501c3.
Yeah, C3 organization. So that covers your majority of your charities, a lot of colleges, alumni, or like college funds,
churches,
religious organizations.
Not all of them, but yeah.
But yeah, and most charities will have some sort of page that will say we are a 501, organization, because essentially, for any kind of donation or stuff like that, they want to show this because it incentivizes people to give money to them because of the tax write-off. Yeah,
exactly. And so that's the direct answer as far as that goes. It's a really great concept. A lot of our clients use that, especially if you're already giving money to charities anyway, and now you can write it off. Essentially, it's not a direct write-off. It just means that if there's a required minimum distribution that would have ended up on your tax return
for income,
it just disappears.
Yeah. So essentially, and you can go up to $105,000. That's the most limit they'll allow. But let's say you write a check to someone that you thought was a charity, but they're not. What would happen? Essentially, it would just look like you would have a distribution of, let's say you wrote the check for $1,000. You would have a distribution of $1,000 of income, but you didn't take any withholdings from that, and so you would have that income on your tax return that you then have to pay taxes for.
Yeah, exactly. Yeah, it's I know it seems a little complicated, but once you get into it, it's not too complicated. It's a great thing to kind of understand and make sure it works, make sure the check's clear, all those things.
Yeah.
So, yeah.
making sure the check's clear by the end of the year is the most important thing. So a lot of times we recommend that you start earlier in the year. A lot of times, like, at the end of the year is when everyone's writing these checks, but maybe you write the checks, you start writing some of these checks in January when it's kind of a low period for the charity.
Yeah. One other thing, this has come up several times within the practice. You have to tell your tax preparer that you did this.
Yes.
Because what your tax preparer is going to see is this $10,000 distribution out of your IRA, let's say, 401k, whatever it might be. And, that's the required document. There is no document that the tax preparer gets from your custodian that says, hey, I gave it all to these charities, because they can't tell. They don't know. They're not. You're not. Your Charles Schwab's of the world. They're not going to figure out whether that's a 501c3 corporation that you wrote that check out to. That's up to you. So make sure if you had $10,000 worth of checks that you wrote for charity, that your accountant knows that that $10,000 worth of that required minimum distribution was distributed to charities. And it's new enough that the accountants aren't automatically asking about it. And we've had a couple situations where people have ended up with this big tax bill they weren't expecting and having to refile tax returns and all kinds of craziness. So make sure that you tell your accountant.
Yeah, because usually on your 1099-Rs that you think it would say, but unfortunately it doesn't. And so you have to put it on your 1040s.
Yeah,
essentially.
They just can't tell, right? So they can tell that the distribution went out. That's easy. But they can't tell what it was for, right? I mean, maybe they'll get that down someday and they'll code all these, but there's so many charities, it's ridiculous. They probably never get that down. Take that back. So yeah, that's up to us. Just like a lot of things, so we have to self-report. It's not automatically reported for us as far as that goes. All right, that's a good question. What do we have next?
So I turned 73 this year, which is my the RMD age. When do I have to actually take my first RMD?
Okay, so once you turn now 73, you have to take what's called a required minimum distribution from your retirement plans. Okay, so this would be an IRA, a 401k, a 403b, a 457 plan, anything that you put money in that you didn't have to pay taxes on when it went in. It was called tax deferred. You then have to pay taxes when it comes out. It's ordinary income, not capital gains income. But the government gets to a certain point and they say, okay, now that you're 73, we want some of that money to come out, whether you want it or not, because we want it on your tax return and we want our tax money. Fair enough. So it used to be 70 and a half, so they did give a little bit of a break to get back to 73. And we'll move to 75 actually in 2033 or 35, one of those two. Anyway, and so when you turn 73, you do have an option that first year. So let's say I turn 73 here in 2024, all right? And so I can take my required minimum distribution out this year, or I can wait until April 1st of next year. And so if the calculation for this year is going to be based on the last trading day last year, which I think was the 30th, right?
Yeah, it usually is whatever your your December statement says. You could use that value.
Right. So that ending December value, there's a table at the IRS that you would take and look and say, okay, age 73, there's a little factor, a number, let's say 27.6 or something like that.
Yeah, and you just divide that total.
You divide that into the value of the retirement plan at the end of that year, and that's what you must take out the next year. So that would be, so I'm sitting here in 2024, I just turned 73. I already know in January what I have to take out. So I have all the way from January of beginning of 2024 to April 1st of 2025 to take that first payment. Now, the problem with waiting until 2025 at any point to take that first payment is that you also have to take the 2025 payment in 2025.
Yeah, so in theory, you could have two RMDs in the same year.
Right. And so there's only one scenario that I've ever seen where you should take two in 1 year. It's because in 2024, let's say I had a big tax event. I sold a house, something happened. I've got a really massive amount of money on my tax return this year. And once I do the calculation, I realize even a double next year would be better than taking one this year and one next year. I've only seen that a couple times in my whole practice. So as a blanket recommendation, you want to take it out in the year you turn 73.
Yeah, that's the generic recommendation. But, your tax situation, always consult with your tax professional.
Right. Now, just quickly, because that comes up often too, is when to take it out each year. And that's a bit controversial. But the fact of the matter is, the average year the market's up, right?
Mm-hmm.
It goes up more often than it goes down. And that's why we are here. It's why we have a business, because the market does make gains over the long term. And so the idea then would be that maybe you take the requirement of distribution at the end of the year, because that, so let's say you have to take 10,000, let's say you make 10% on that before you take it out. That extra $1,000 that you made now gets to stay in there and continue to grow. There's a lot of people that take it at different times because they need it.
Mm-hmm.
And that's fine. That doesn't matter. Take it monthly, quarterly, semi-annually, whatever you want if you need it. If you don't need it, then waiting till the end of the year, on average, it's going to, didn't work in 2022, right? The market was down.
Mm-hmm.
I've been better off taking it in January, but it worked in 2023. It would have worked in 2024. It would have worked in 2021 and 2020, right? So, matter of fact, it would have worked in 2019 for that matter. Wouldn't have worked in 2018.
Yeah.
So if you look at that, what is that, 6, 7 years? 4 of them, 5 of them are positive for waiting to the end of the year. So anyway, that's a little thing. We end up doing a lot of required minimum distributions at the end of the year because of that. But it's, I think, not a bad strategy.
Mm-hmm.
All right. Well, do we have time for one more?
Yeah, sure. So what happens if I pass away and my HSA still has some money in it?
Okay. So HSA is a health savings account,
Yeah.
and it's kind of a really cool, actually. You get to put the money in pre-tax, so you don't have to pay
it's tax
taxes.
deferred.
So if I put in 10,000, I didn't have to pay tax on that 10,000. That's cool. And then if I take it out for medical expenses, whatever growth I got
Is
is
tax-free.
tax-free.
So it's one of the most powerful accounts because
Yeah.
with the
It's the
Roth
only
you
one.
only get tax-free growth.
Right.
With a 401 or traditional you only get tax deferred.
Right.
But this kind of account combines both when used for qualified expenses.
Yeah. So before I answer that question, it's becoming a really strong strategy for people to start accumulating their HSA,
Yep.
and specifically trying to find an investment program to put it into, to try to maximize return for that HSA, and then use it during retirement to pay for medical expenses. But then you get into this question, which now you might actually have something left in that HSA, because a lot of people deplete their HSAs every year, and they're missing out on the tax-free growth. So if you did accumulate something and then you pass away with that, what happens, right? So
Yeah. So if you have a living spouse, they can just take over that HSA account. So there's no kind of change of tax. It's just basically they acquire it. It's kind of like how with a IRA, they can kind of just bring it into their own IRA. So that's a very easy, no taxes, nothing. It's just a transfer essentially. When it's a non-spouse beneficiary, that's when you actually have a tax hit. So you have to distribute the HSA, and then it becomes taxable income.
yeah, like the IRA. So if I inherit an IRA from, say, my father, he never paid taxes on that, and now I'm inheriting it, I have to take it out, and it's taxable. The difference is the IRA, I can take it out over 10 years.
Yeah,
or 5
unfortunately
years.
with the HSA,
Right.
it's essentially that year that the person passes away, and it is the year that it gets processed, the whole death claim, you'd have to pay it out.
Yeah.
The one thing that they allow is, though, you can write it, if let's say your father passes away, he still has some medical expenses that haven't been paid, you can use those medical expenses that are paid post-death to write against the actual income. So you can lower that income down, essentially.
There's a period of time. Is it like 12 months you can
Yeah,
do that?
it's a
after
12 months grace period
Yeah,
that you can
okay.
use to pay.
Yeah, that makes sense. So that's pretty interesting. It makes sense to me. Not every tax law makes sense, but no taxes were paid. The person and or spouse could use it tax-free for medical. Next generation or other beneficiaries have to pay the tax, just sort of like the IRAs. That makes sense too. And it's nice that you can use it, for final expenses potentially for up to 12 months.
Yeah, so
Tax-free also, right, for those.
Yeah,
for
so
that portion. Or I guess it'll write down the taxable income that you have.
yeah, because essentially you have to still pay that tax.
Yeah.
Those expenses.
Yeah, get it. All right, well, that's a great show today. We spent a lot of time today on the summary, talking about what seems to be the hot subject, which is what do we think is going to happen as far as that goes. So hopefully that helped some. We'll continue to try to make that a little bit more clear. Feel free to ask questions about what we talked about today, clarifying questions or other areas that you think we missed as far as that goes, or any things that you disagree with. We'd happy to hear that too. We would discuss that. We're working hard to try to figure out what all this means ourselves too. And you're dealing with an unpredictable situation in terms of what will actually happen.
Yeah,
If we
these
knew
are all
for sure,
proposed.
yeah,
These are all things that they put on the campaign
yeah,
trail,
yeah,
but they have to still. Some of these things still have to go through Congress.
yeah. I do think it's worth asking about and learning about because it is an area so that we can be more prepared to react. But based on a better knowledge base. Okay, so thank you very much for coming today. Look forward to seeing you again next week. Please send in your questions. Ask Tom at talkmoneywithtom.com, and we'll try to gather those up for the next time we get together here next Friday. You can go to our channel and subscribe to the channel, and hit the bell button for notifications. And of course, if you'd like to meet with Ethan and I one-on-one, you can do that. There's a book appointment button there right on our website. So. Look forward to a chance to see you again next week or maybe talk to you in the future. Thank you very much.